Welcome back to more cost of capital in the wonderful world of finance. I do really enjoy these topics. I guess maybe that's a cry for help. But I know they also can be confusing and difficult. If you're having problems, make sure that first you're reading the book. The book is interesting, has lots of good examples. There's things in the book that I'm not covering. So what I recommend you might do is read the book and have alongside it the PowerPoint slides. That way you can take notes on the PowerPoint slides, get all your thoughts together and see what the aspects are that I think are most important. And then, of course, head to the videos. And if that doesn't help, ask me. You can also try Googling. It's amazing how many things you can find on Google. But don't be afraid to ask me. All right, so let's continue with cost of capital. We've talked about the cost of bonds. Let's take a look at the cost of common stock. Now, common stock doesn't pay interest. There's really no permanent dividend, so we're going to have a little difficulty looking at that. But when we do sell it, there is flotation costs. Now, when we look at equities on the balance sheet, you'll recall that there's both common stock and retained earnings. Retained earnings are the profits, you'll remember from financial accounting, they're the profits that are plowed back into the business. And the owners are entitled to them. They're part of the equity of the business. Well, there's no transaction costs on that money that's raised. The profits that are raised, that's the business. It didn't have to pay anybody else any money other than the government for taxes, but the retained earnings are what's left, and there's no transaction costs on those. However, that doesn't mean there's no cost of capital. Let's first talk about the common stock. When you float stock, in other words, sell stock, you're going to have flotation costs, and you expect, the owners expect, a return on that money. Now we can go back and use our simple dividend valuation model and say the cost of capital is equal to the dividend divided by not the price, but the net proceeds. We might sell it at $40, but only get $38. So we want to use the net proceeds. Just like in bonds, we're going to use the net proceeds. But it's basically the dividend yield based upon the net proceeds, plus the growth factor. So if we can remember the required rate of return from before, instead of price, we just substitute net proceeds. Now retained earnings. Why do they have a cost of capital? Well, because our investors, the owners, expect a return on that money. Otherwise, give it back to them. They expect a rate of return. So the cost of capital we're going to use for retained earnings is the capital asset pricing model. So we're going to assume that's the value. That's what the owners are requiring. That's going to be the cost of the common stock. Kind of makes sense, right? If you're an investor, you already have stock, you're going to use the capital asset pricing model to take a look at your expected rate of return, and if that's your expected rate of return, then that's the cost of keeping that money in. That's what investors assume. Wait, what's going on here? Moose, I warned you, no using phones in class. Put it away. Papers. Oh, but I do like your flip phone. So let's take a look at an example. Here for common stock, we've got an investor's view. And it pays $2.50 a dividend, has a price of $50, growth rate of 10%. So we can use the capital asset pricing model to see what the owners want. Owners want an expected rate of return of the dividend yield plus the growth rate, 15%. From the firm's point of view, they still pay the $2.50, but they only got $42 after the investment banker took their cut. So we can plug them in the same way, although you notice here there's $42 instead of the $50. And so the cost of capital is a little higher. From the viewpoint of the firm, they have to make more money than an existing stockholder or investor would see. Yeah, so the problem is, how do we determine the cost of capital when we sell both stocks and bonds to raise money? Who's that?
It's Jocko.
Jocko?
I know the answer to that question.
Yes, Jocko.
Okay, we could use a weighted average like we do for calculating a portfolio's beta.
Ooh, excellent, Jocko. Somebody was paying attention that week. Yes, we're going to take the cost of each source of funding, so stocks and bonds, and get the cost of capital for each of those, right? Then we're going to know the weights. Basically, the weight is what percentage is stocks and what percentage is bonds. And then we'll calculate the weighted average. So you'll see here the formula for the weighted average cost of capital. It's the weight of the common stock times the cost of common stock. The weight of the bonds times the cost of bonds. And the weight is simply the percent. Now, when you do this, make sure you look at the 30% and the 70%. These numbers should total 100%, right? If they don't, you're not doing something right. Something's wrong. So you calculate, you plug in the values, and in this case, we come up with 28% as 18% plus 28%, and our total weighted average is 46% as our cost of capital. Again, take a look at this. You want to have your cost of capital somewhere between 30% and 70%. If you calculate a number that's 20%, you got it wrong. Or if you calculate a number that's 80%, you've got it wrong. Always do a sanity check when you do these things. You'll correct a lot of mistakes that way. All right, so the weighted average cost of capital is used by making investment decisions. We want our expected return to be greater than that weighted average cost of capital. Now, when we do this in practice, they may change each year, right? We're going to change how many bonds we've got, how much stock we've got, our leverage will change. So in that case, what we want to do is use what our target capital structure is. And by capital structure, I mean our target for the percent of bonds and the percent of stocks that we're going to have. So calculating the weighted average cost of capital uses the same principle as we used in calculating a portfolio beta or the expected returns with probabilities.
Professor Klinger?
Yes, Jocko?
I don't understand. Why would I use the same cost of capital for all projects? Some projects are riskier than others. For example, like building a brand new hydrogen car is riskier than building a new Corvette. And I imagine, even though he hasn't shown me his books, I imagine that Elon Musk's SpaceX project, the cost of capital there is probably much higher than his cost of capital for his Tesla car.
Very good points, Jocko. Yes, in large companies, different divisions will have different risks. And you're exactly right. The SpaceX is far riskier than potentially the Tesla division. Disney, the Disney Plus may be bigger risk than the theme park. So businesses will adjust their cost of capital for each of the divisions. And then the projects in that division will have to have that as a hurdle rate.